For decades, this was it. The closest thing you could get to a sure bet in global finance. It was a simple, elegant strategy that basically just printed money. But when this absolutely massive worldwide bet finally broke, well, it didn't just fail. It sent shockwaves to the entire system that we're still feeling today.
And then, boom. In the summer of 2024, a tremor that started in Japan rippled across the entire global financial system. And this wasn't some natural disaster, it was a financial one. An earthquake, as Investopedia so perfectly put it, that exposed these deep, hidden cracks in what so many people thought was a totally safe and reliable way to make a buck.
And the crazy part is just how fast this all went down. It kicked off in mid-July with just some whispers, market chatter about central banks changing their minds. Then, on July 31st, bam, the Bank of Japan actually does it, announces a rate hike. By early August, that move triggers a frantic mass sell-off. The whole thing just completely unraveled in a matter of weeks, catching an army of traders totally and completely off guard.
So you have to be asking, what on earth just happened? And more importantly, why should you even care? Well, to really get this whole earthquake, we have to first understand the financial tool that was right at its epicenter, a strategy called the currency carry trade. Now, it sounds complicated, but I promise you, the basic idea is surprisingly simple.
So this whole massive global strategy, it really all starts with a simple idea. Think of it like you're bargain hunting, but not for cars or clothes. You're shopping for the best deal on money itself.
Okay, so here's the deal in super simple terms. Imagine you go to a bank and they offer you a loan at, say, 2% interest. Then you take that exact same money and you put it into a savings account at another bank that pays you 5% interest. You're literally making money on the difference, on that spread between the two rates, without doing much of anything.
And here's the playbook. You borrow cheap, you invest where the returns are high, and you just pocket the difference. For years and years, this was one of the most popular plays in the foreign exchange market. But, and this is a huge but, the entire thing hinges on one single critical assumption, that the exchange rate between those two currencies stays nice and stable. And here's a quick look at what that actually looks like. Let's say you borrow 14 million yen at a ridiculously low 0.1% interest. You swap it for US dollars, and you invest that to earn a pretty solid 5%. As long as that yen to dollar exchange rate doesn't move against you, you've just made a nice profit purely from that interest rate gap. On paper, it looks like free money, right? Almost too good to be true.
And that is where this sailboat analogy just hits the nail on the head. Because the success of this whole thing depends entirely on the market being stable. It is a fair weather sailboat. When the seas are calm, it's a smooth, profitable ride. But the second a storm hits, that little boat can capsize in a heartbeat.
All right, so that begs the question, why Japan? Of all the currencies in the world, why was the Japanese yen the absolute center of this massive global bet for so long? What made it the perfect funding currency? Well, for decades, Japan was in this really unique economic situation. They were fighting falling prices, they had an aging population, and just overall sluggish growth. And all of that basically forced their central bank to keep interest rates pinned down to near zero. Now, the goal was to get their own people and businesses to borrow and spend, but global traders saw something totally different, a massive, nearly free source of cash.
And this number, 260%, this is the real key. This is why everyone felt so ridiculously safe. With government debt more than 2.5 times the size of its entire economy, the market just assumed Japan could never raise interest rates. The debt payments would be absolutely crushing. And that conviction is what turned the yen into what seemed like a permanently cheap, totally stable currency to borrow against.
So this perception of almost permanent stability created the absolute perfect conditions for this carry trade to grow and thrive for years. But what happens when those supposedly unchangeable conditions finally change?
For years, traders were living the dream scenario you see on the left. It was a calm sea of cheap yen and high-yielding dollars. But then came the storm of 2024 on the right, and every single one of those perfect conditions didn't just change, they inverted all at once, catching that little sailboat in an absolute hurricane.
And here it is, the first domino to fall. In March of 2024, the Bank of Japan did what almost nobody thought was possible. It ended its negative interest rate policy. Now, it was a tiny move, really, but it was the signal the market had been choosing to ignore for years. The era of ultra-cheap yen was officially over.
And just like that, traders got slammed with this brutal 1-2 punch. First, their cheap yen loans started getting more expensive, but the real killer was the stronger yen itself. The debt they owed was suddenly worth way more in dollar terms, which turned years of carefully built profits into catastrophic losses seemingly overnight. It was a stampede for the exits.
Now, this wasn't just a problem for a handful of currency traders in some niche market. Nope. The collapse of this one single bet sent ripples across the entire global economy, and it hit markets that, on the surface, seemed totally unrelated.
And that's the real question, right? How are all these different markets so deeply connected? How does a currency trade between the yen and the dollar actually cause the S&P 500 to drop?
Well, the key is just realizing how much money we're talking about. Trillions of dollars were tied up in this one strategy. So when it unwound, all that money had to move. Huge Japanese investors started dumping their U.S. bonds to bring their cash back home. As they sold, bond prices fell, which automatically pushed interest rates or yields up. Suddenly, borrowing got more expensive for everybody in the U.S. That uncertainty spooks the stock market, and those shockwaves kept going, hitting places as far away as emerging markets.
So in the end, the great unwinding of 2024 is a powerful, frankly scary, reminder of just how interconnected our financial system really is, and how quickly a so-called safe bet can become a source of global chaos. It leaves all of us with a pretty critical question. In a world full of these complex financial plays, where's the next sure thing that's just waiting to unravel?